In the past 4 years, we have seen unprecedented growth in the Omaha real estate market, and it's natural to assume that what goes up must eventually come down. So, why hasn't the Omaha real estate market crashed yet? Is it just a matter of time? In today's video, we're going to go over 7 reasons why the Omaha real estate market has not crashed, and we're going to get started right now. Hi, my name is David Matney with Nebraska Realty. I'm a local realtor here in Omaha, Nebraska. Now let's jump into today's topic. Let's take a quick look at what kind of price increases we have seen in the Omaha market. This is from the Great Plains Multiple Listing Service, and it shows the median closed sales price for the Omaha region. Looking at this chart, you can see that in January of 2020, the median closed sales price for a single-family home was $196,000 in the Omaha region. Today, the median closed sales price for a single-family detached home in the Omaha region is $332,500. Why has this happened? Let's first take a look at new construction. Some of the issues of today's housing market have their roots in the Great Recession of 2008-2009. Nationwide, we did not build enough homes in the past decade. If you look at the number of homes built in the past decade and compare it to the previous decades, we clearly did not build enough homes in the 10 years after the Great Recession. Omaha was no different. In the years leading up to the Great Recession, it seems like everyone was either a general contractor or a new builder. In fact, many agents became builders too. Once the Great Recession hit, that all went away, and in fact, several builders went bankrupt in the Omaha area. That's going to have an impact moving forward. Builders are going to be much more cautious moving forward once they've learned a lesson from the last recession. Then we had the pandemic with supply shortages. This meant homes that would normally take 8 to 9 months to build now took 12 to 14 months to complete. Some builders would limit the number of contracts each month. For example, one builder would only allow their reps to write 3 contracts per month. At that time, there was a waiting list for new construction. We also had builders who had to deal with material shortages that created wild fluctuations with material prices. Let's take a look at the price of lumber over the past decade. Look at the price of lumber during the years of the pandemic. The lumber mills were shut down. At the same time, we had record low 30-year fixed rate mortgage interest rates. The low rates fueled hyper demand. With no lumber to build new homes and hyper demand, we had a severe inventory shortage. Let's talk about interest rates. When you build new construction, you cannot lock your rate until 45 days before closing. When rates were below 3%, and when inflation was starting to take off, everyone knew eventually interest rates were going to go higher. It was not if, it was a matter of when. And if you were building, you took a real risk back in 2020, 2021, because when was your home going to be done? And what would be the rate? That put even more pressure on the existing market, causing homes on the existing market to receive 45 offers. Interest rates during the pandemic meant the low rate made homes more affordable. They could afford to buy a higher priced home because of the low interest rate. The super low interest rates also meant that anyone who owned a home and had a payment would refinance, and this locked people into a super low payment. In order to control inflation, the Fed raised interest rates. Starting in January of 2022, rates were at 3.29% for a 30-year fixed rate mortgage. In January of 2023, rates went up to 6.54%. These higher interest rates made homes much less affordable, and more buyers were pushed to the sidelines. For example, in January of 2022, the median sale price in the Omaha region was $261,000. What was the monthly payment? And we're just looking at principal and interest. For a purchase price of $261,000 with 20% down payment, you financed $208,800 at a 3.29% interest rate. Your monthly payment, and this is principal and interest, would be $913.30. These lower rates had another effect. These low rates attracted investors. Many of these investors swooped in and gobbled up these homes on the existing market. These investors were cash buyers and were willing to overpay for a property at the time. These investor buyers pushed many first-time home buyers out of the market because they couldn't compete with cash offers. In January of 2023, the median sale price in the Omaha region was $269,000. What was the impact of the interest rate on the monthly payment? So you had a purchase price of $269,000 with 20% down, and this time you finance $215,200 at a 6.54% interest rate. Your monthly payment, principal and interest only, was $1,365.88. We had both increasing prices and increasing interest rates. Now keep in mind, the definition of inflation is when too many dollars are chasing too few goods. The rapid increase in interest rates meant many people who refinanced or bought a home during the pandemic years were locked into a super low interest rate, and as rates increased, they're less likely to move. Let's talk about jobs. The real estate market is directly related to the job market. When a job is created, it adds a buyer to the market. We have a record low unemployment rate in Nebraska. In the Omaha region, the unemployment rate is 2.2%. We have a very diverse economy with many jobs in the Omaha area are not necessarily service related. We have jobs in education, transportation, technology, and in healthcare. Also, as a state, we didn't have the shutdowns that you saw in other states. This meant that more service-related jobs and businesses were able to stay in business. So we didn't have the massive layoffs that you saw in other states. We also have seen the rise of the remote worker. Our unemployment rate, quality of life, and affordability attracted remote workers and people to the state of Nebraska. A home for $350,000 in the Omaha region looks like a smoking deal compared to states like California, Oregon, or New York. Buyers could sell their home in California, buy a larger home in Omaha with a better school system and a higher quality of life as long as they could tolerate our weather. Let's talk about inventory. We have fewer homes on the market. Homeowners who currently own a home are only selling if they have to sell because they have a low interest rate. Overall, we have 1.8 months of supply of homes on the market. This means if no other homes that come on the market, it'll take 1.8 months to exhaust the current inventory. And remember, a seller's market is 0 to 3 months of inventory. A neutral market is 4 to 6 months of inventory. And a buyer's market is 6 months of inventory or more. Keep this in mind. Bad news sells. News about a crash gets clicks and headlines. When you have a seller's market and you have low inventory and high demand, prices go up. 1/3 of all agents have been in business for less than 5 years. Those agents don't have the reference point to compare today's market to the market of 2008. Also, even back 5 years ago, people were talking about an impending crash. For example, Google real estate crash and type in a year, and somebody thought the market was going to crash. Everyone wants to be the person to call the next crash. In the Omaha market, even during the crash years, we did not see prices go down like a market in Las Vegas or the market in Phoenix. Our prices during the Great Recession were relatively flat. There was 6 months of inventory and homes took longer to sell, but our prices did not tank. Now, did we have some price fluctuation? Of course. If you were in the wrong loan product or if you lost your job, you were hurting. In any market, when you buy a home, you have to have a long-term outlook. Buy a home you can afford, pay your payment, save some money in case you get a rough patch, live within your means, and you're going to be okay in the long run. It sounds simple, it's just not easy, and it might be a little old-fashioned, but don't buy a home you cannot afford to impress people you don't like. In the years of the pandemic, we had an unhealthy and unsustainable seller's market. 45 offers on a property and paying $50,000 over list price and waiving the appraisal and the home inspection is not normal and not sustainable. However, just because prices went up doesn't necessarily mean they're coming down. Right now in the Omaha market, we have a market $300,000 and below where homes are priced right and in good condition are still receiving 3 to 4 offers. And in the $300,000 price point and below, we have less than 1 month's supply of homes on the market. We have another market, $500,000 and above, where homes are taking longer to sell because the pool of buyers is simply priced out of the market at those higher interest rates. At the $500,000 price point and above, we have a balanced market with 4.5 months of inventory. Let's talk about aging in place. Senior citizens are more likely to age in place versus moving to a senior living facility. A senior moving from a single-family home to a senior community is going to free up a home to the marketplace. But if you choose to age in place, they're not going to put their home on the market until they pass away. Item number 6 is going to be millennials. According to the National Association of Realtors, the average age of the first-time home buyer last year was 36 years old. If you look at the current demographics of the United States by age, the largest segment of the population is millennials. This means the largest segment of the U.S. population is currently at peak home buying age. This adds to the demand for housing over the next several years. Number 7 is financing. In the last Great Recession of 2008, we had subprime lending. In the early 2000s, there was a push to advanced home ownership, which is a good thing. However, when you loan money to people who don't have the ability to pay it back or are in the wrong loan product, that's going to lead to disaster. When I first started selling real estate back in 2003, there were a lot of 100% financing programs. It was actually kind of rare to do an FHA loan back then. And that all changed after the Great Recession. It was tougher for buyers to get pre-approved. Buying a home is a big decision, and the market is always changing. Markets go up and markets go down. Trying to time the market is a fool's errand. Eventually, the market will change. Nobody can predict the future, and I always think you should exercise caution and do your due diligence. Don't let anyone talk you into or out of what's best for you and your family. Buy a home you can afford at a payment you're comfortable with, and with time, eventually you'll come out on top. If you're one of those folks that are priced out of the market, or if you're a buyer in one of the lower, more competitive price points, don't give up. And if you want to learn more about the Omaha real estate market, be sure to watch this next video. Make it a great day.